Welcome to the Economic Preparation and Depression Channel. I'm your host, Tony. Thank you for joining me on this Wednesday, Hump Day, September 18, 2024. Well, the all-anticipated rate cut has in fact happened as of 2 p.m. Eastern Time. A 50 basis point rate cut, which was much more than expected or anticipated by economists. They were looking at 25 basis points, but a 50 basis rate cut to start the kickoff of quantitative easing again, ladies and gentlemen. So you might want to hold off on buying that new house because it looks like rates are going to be going down, at least in the short term, on mortgages, car loans, and credit cards. Up until the Fed decides to hold them steady again. But it looks like in the short term, rates are headed down. We'll reach the peak of savings for Americans that were saving money in high interest yield savings accounts and money market accounts and other accounts. Looks like those percentages are going to be going down, those APYs. So one article says here, don't waste your money. Interest rate cuts may mean lower mortgage rates on your home. So we'll see how far mortgage rates will go down. It's anticipated that mortgage rates could get back down to around 4.8 to 4.9% by the time this year is out. But we'll have to wait and see on that. But the Federal Reserve has cut interest rates, and they have began signaling to the markets that quantitative easing is in effect. But stocks did not grow up that much as anticipated. Right now, Dow Jones is up around 80 or 90 points. It bolted up. It was down or flat for most of the morning. And now, as soon as that news came out, it's funny how the algorithms get it. And now the stock market is going up now. We're almost 100 points now, which is modest considering the supersized rate cut. I mean, we haven't had a 50 basis point rate cut in some years now, and this aggressive start to its quantitative easing campaign since 4 years. It's noted by CNBC, MSNBC, all of the big channels, of course, noting this as expected. And this signals to me that they're really concerned about, they were concerned about inflation, but they're concerned now about the job market cooling off, the unemployment rate spiking, and the job market cooling off after the election season. I think that's where their focus is going to be turned to. But of course, the two-headed monster hasn't gave up. Like I said, inflation is still high. I don't need to tell you that. As well as the job market it's definitely cooled off in the last 2-3 years, obviously. So they lowered its lending rate overnight, lending rate to 4.75 to 5% from 5.25 to 5.5%. The magnitude of the rate cut came in line with traders' expectations, according to CME Group's Fed Watch tool. So this is the first time in 4 years that the rate cut had been this significant for the markets here. And so we'll have to wait and see how the market reacts. But bank stocks were one of the few gainers. Of course, they popped during the rate cut now. And home building ETF stocks also popped. But Ray Dalio, according to Fortune magazine here, he's a long-term China bull. Ray Dalio fears economy faces problems as severe as Japan in 1990. And once again, you've heard this on my channel earlier. Previously last year, we were talking about this, and we were saying that, we're going to be in that lost decade from 2025 to 2030 or so, lost half a decade or so, where we're going to have stagflation, high prices, high unemployment, and slow growth. Even in the automation economy or AI economy, this is what we're going to be facing, kind of like what Japan is facing or was facing. And so this is going to be something that a lot of the long-term experts are seeing as well as we head into this new economy. And we'll just have to wait to see how that plays out. The Dow Jones jumps after the Fed rate cuts. You can see everything is in the green right now. Even Bitcoin is up to 60,000, over 60,000. Crude oil's down. That's surprising as we get to winter time here, $70 a barrel. Dollar's down. Futures are up. Barron 400. Everything is up. The VIX is up. 10-year, 2-year. NASDAQ, S&P 500, the Russell 2000's up. Everybody's in the green. Everybody's excited. There's the Roaring 20s. Once again, these markets continue to rally. But the question is, there's two questions that linger on that we all have to answer, ladies and gentlemen. How long are these rate cuts going to last, number one? And to what extent do they pause and begin to raise rates again if they see unemployment spiking above 5 or 6% next year? And also, we have to ask ourselves, is this really helping the Main Street Americans' economy, pocketbooks? Is this putting more money back? Remember, we still have $36 trillion debt nationally on this economy. And so just a little rate cuts like this, does it really help the long-term problem that we have, a spending problem that we have on all levels of government and in the private sector as well? Companies are carrying debt on their balance sheets, and that's one of the reasons why they're going to reduce workers and get automation in and get unskilled workers in from other countries. Obviously, they're bringing in the replacements now as we speak, and so, but they can hire them at cheaper. But is that going to be enough to save a lot of American companies that have headquarters here, or multinational headquarters, I don't think it's going to be enough. So this is just going to be a short-term band-aid on a gunshot wound for the next 1 year, maybe for the next year and maybe year and a quarter. But everybody universally agrees that somewhere in 2025, 2026, there's going to be a downturn. And this downturn is going to be severe. That's going to last, a severe recession that's going to last more than 2 to 3 years. And this is where the rubber meets the road at, because there's only so much money you can print for infrastructure improvements, print over to pay the interest payments on the debt load. And there's only so much money you can print without causing hyperinflation in a system that's designed to work on consumption. 3/4 of the U.S. economy is based on spending, consumption, ladies and gentlemen. There's only so much that can be consumed. You reach a point of diminishing returns in the highly developed countries, like U.S., U.K., etc., the G7, G8 nations. So that's going to be the big problem, and people can see it. They see the writing on the wall, and they're getting into tangible, hard assets. And that's what I recommend. I always recommend on this channel for you to do is take the paper money, get into tangible, hard assets, land, real estate, oil, silver and gold, cryptos if you must. I mean, if you go that way, that's fine. But just, like I said, that's going to be the breaker coming up in late 2025, beginning of 2026, when all of the money printing stops, and when they have to raise these rates again. That's just going to be the breaker for this economy, because the medicine is wearing off. As you can see, the medicine only works for so long, and it's going to be wearing off. It's going to become of no effect here. These rate cuts are going to become of no effect because unemployment is going to be too high. The Americans are going to be civil unrest. Crime is going to go up. Everything's going to go up because people are going to be fed up with paying taxes, higher taxes to pay for this stuff, and not seeing any results on the streets in these cities and in these counties, municipalities, and that's going to be the big problem. So they're buying time now, but how long will that last? Not long. So continue to prepare, and we're going to be okay. God is going on our side. He's going to take care of us. He always has taken care of us, but we have to do our diligence to make sure that we're put in the best position, putting our best foot forward every single day, despite the headwinds that we're going to see with this economy in all regions of the economy. So God bless. Just want to bring you the update on the rate cut news that you've heard, I'm sure, on CNN and MSNBC. But this is what this means, is that they're trying to get ahead of this unemployment now. They're not really concerned about inflation. They're trying to get ahead of this unemployment wave as companies realize that the credit situation next year is going to be drying up for business and commercial real estate loans as that becomes due, and many people foreclose on a lot of these hard properties out here, commercial properties out here. That's what this means here. So God bless. I'll talk to you very soon in the next episode. Thank you. Please be sure to subscribe and tell others to subscribe so they can get the notification, because I've heard people not getting the notification. So make sure you subscribe and hit that like button so you can get notified of when the latest video comes up, and I'll be sure to read and like your comments as well. Thank you.